What is up, everyone? Welcome back to Wall Street Radar. Today, the streaming king is bleeding out. Netflix just dropped Q4 earnings, and the market is reacting like it's the end of an era. Shares are getting absolutely wrecked after hours, down over 5%, hovering in that dangerous $82 to $83 zone. This isn't just a minor pullback. This is a high-volume liquidation by the big institutions. Is this the ultimate buy-the-dip opportunity of 2026, or a total red flag signaling collapse? We are talking $82 billion deals, massive debt shifts, and retail panic versus institutional repositioning. Let's look under the hood. Revenue came in at $12.05 billion, beating the $11.97 billion consensus by $80 million. That's 18% year-over-year growth. In this macro environment, those numbers are actually insane. Subscriptions smashed expectations, hitting 325 million members. They blew past the 320 million forecast. Even the bottom line beat. Actual EPS hit 56 cents versus the 55 cents expected. So why is the stock crashing? Because the market doesn't trade on the past. It trades on the future, and the future looks expensive. 2026 revenue guidance hit a low end of $50.7 billion. The whisper number was $51 billion plus. Now for the real bombshell. Netflix is pausing their massive $2 billion quarterly share buyback program. For years, those buybacks provided the floor for shareholders. Now, that floor just vanished. They are hoarding every cent for a monster move. An $82.7 billion all-cash bid for Warner Bros. Discovery. They want HBO, they want Harry Potter, and they want the entire Warner movie studio empire. This is a play for a content monopoly. Netflix wants to end the streaming wars for good, but all cash means emptying the war chest and taking on massive leverage to win. Paramount was circling WBD with a $30 hostile offer. Netflix just dropped a nuclear bomb. By switching to cash, they're forcing WBD's board to ignore Paramount's paper-heavy bid. But check the cost of war, a $42 billion bridge loan. Debt is spiking to the moon. This sends their debt-to-equity ratio into a whole new dimension. Investors are absolutely terrified. They are trading a pristine balance sheet for a library of old IP. Is Harry Potter worth it? Wall Street isn't convinced. The April 2026 closing date feels like a lifetime away. Even without the merger, content spend is jumping another 10% this year. The race is on. They are fighting Disney and Apple for every eyeball. Operating margins are getting squeezed to 31.5%. When margins contract, multiples compress. That's why the Q1 EPS guidance miss hurts so much. Q1 EPS guidance is just 76 cents, missing the 0.81 consensus. It's getting harder to keep subs. Ad tier revenue is growing at $1.5 billion, but it's not enough to offset blockbuster costs. Let's look at the charts. At $83, Netflix is trading at a forward PE of 28 to 35. Historically, that is cheap, but the RSI, the Relative Strength Index, just hit a rock-bottom 25. Anything below 30 is oversold. We are officially in capitulation territory right now. The stock is screaming, "Buy me," but momentum could still flush it down to the $75 level. Long-term bulls are licking their chops. Analysts see a $135 target, 50% upside. Now, let's address the FUD. Director Bradford Smith sold $2.8 million of stock on January 15th. Stop the panic. This was a pre-scheduled 10b5-1 plan set up months ago. No shady dump. He still holds over 80,000 shares. This wasn't a signal to run. It was just a Tuesday. Don't let headlines distract you. The insiders are still in the game for the long haul. Bottom line, Netflix is playing for world domination. If they win WBD, they win it all. My strategy? I'm buying, but I'm not chasing. Based on that $75 to $80 support range, I'm scaling in. First entry at 80, second heavy entry at 75 if we get that final flush. This DCA approach lets me ride out the $42 billion debt spike while waiting for the 135 target. But I have a hard exit. If we see a weekly close below $70, I'm out. Below 70 means the technical floor's gone and the debt risk is too high. Discipline over ego. What's your move? Buying this dip or is the debt too much? Let me know in the comments. Smash that like, subscribe to Wall Street Radar for more breakdowns. See you at the bell.